Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is your Cannabis Business Podcast. Today, we are cruising with cannabis. It is 420. We're going to do 20 stores on 420, all within 4 hours and 20 minutes. We are here at Jimi Hendrix Park. We are going to be cruising to our first store, which is Uncle Ike's on 15th. Uncle Ike's has 3 locations, or 5, or I don't know, a lot. So I'm here with Norm Ives. I'm also here with the Emerald Wizard and his lovely elf. Norm, this past year, Norm here. Past year, Norm was elected board member of the Cannabis Alliance, Washington State's largest and most influential nonprofit advocating for the advancement of a vital, ethical, and sustainable cannabis industry. He was a panelist for Business Insurance Masterclass, Cannabis Cover, held in Denver and Los Angeles in March 2019. This spring, Norm was invited to speak by the Defense Research Institute of Washington, D.C., to the International Organization for Attorneys defending the interests of business and individuals in civil litigation for their May 2019 installment of Cannabis Law. And Norm recently joined Worldwide Facilities, which has been delivering innovative insurance solutions since 1970. Worldwide Facilities is a national wholesale insurance broker, managing general agent, and program underwriter. Their team of insurance specialists have access to virtually every specialty domestic and international insurance market, including coverage for hemp and cannabis businesses. So as the use of cannabis becomes more mainstream, it'll affect multiple lines of insurance, including workers' comp, health, auto, property and casualty, D&O, and life, just to name a few. So according to the AM Best report, there's several different marketing segments related to cannabis that lacks insurance coverage. There's been some insurance companies interested in looking into this opportunity. There's about 25 insurance carriers that have taken their first step into the cannabis insurance market in the United States as well as Canada. But that said, how does one go about picking the right broker-agent-underwriter, and what makes Worldwide Facilities the one to choose?
Worldwide Facilities is actually, we're a wholesale broker. And so we don't actually deal directly with the insureds. We're the ones who actually go out to the market. We've brought 2 new carriers to the insurance market. So on the casualty side for liability policies, and we've brought some more players to the table as well on the property side. So that's kind of the role that we fill in the market. Is we go out there and help identify carriers that are their appetite and their marketing would lead us to believe that they're natural partners for us to pull into this space. My team within Worldwide Facilities is called the NutriRisk team, and we specialize specifically in nutraceuticals. My partner Morgan Moore has been more than 20 years in the health, wellness, nutraceutical space, and we've leveraged those relationships. Cannabis really isn't all that different from when health, wellness, nutrition drinks, lifestyle products that maybe aren't quite FDA regulated yet or are new to market. Those industries pair very well with cannabis in the same trajectory as we start to kind of peel back the many layers of the onion of prohibition.
There are real opportunities and risks in the cannabis industry, which insurance can provide peace of mind. This can include insurance for personal growers, retail shops, transportation and logistic companies, as well as research and development. Commercial growers face particularly intense exposure as damage at any point in the growing or storage could spell catastrophe. So can you quantify with an example why it's imperative that all cannabis companies consult their insurance provider prior to operations?
Well, what's critical is understanding how to make the most of the coverage that is available. Really, that's probably the biggest challenge, or what I spend a lot of time doing when I'm speaking to the end insureds is understanding what coverage is available and where it's at. For instance, you wouldn't want to pay for insurance on a product twice if you didn't have to. And so understanding where the classifications of the product is important. Up until a product is put inside its final packaging bag in the state of Washington, it's considered harvested product. Well, if you're a savvy business owner and you understand how your insurance works, you probably would never buy inventory coverage if you were a producer processor in Washington, because once you put it in that final sealed bag, it's probably out the door within 24 hours. So why would I want to pay to insure it when it's curing and drying, and then package it only to pay to insure it again as inventory on my shelf? And so understanding where the coverage begins and ends can help you kind of modify your operation so that you're not spending money on insurance, basically purchasing coverage twice.
So in addition to finding a policy that protects losses of precious biological assets like genetics and related IP, cannabis companies require a wide range of critical coverage, including commercial general liability, stock and business interruption, D&O, and even terrorism. So maybe the key question a cannabis business should be asking before choosing an insurance company is, are you certain the carrier will actually pay out when you need a claim paid? So how is the insurance market covering the cannabis and hemp industry?
Inconsistently. It really depends on the quality of the policy and who you're buying from. Up to this point in the market, in the cannabis insurance market, Lloyd's of London pulled out of the market in October of 2015. And after Lloyd's pulled out, really we had only two legitimate insurance carriers that provided product liability coverage. So if somebody got sick on your product, there were only two insurance policies that legitimately covered that product that was out there. And so
the market is evolving daily, and as carriers can comprehend their risks and expand their appetites, options increase in the market. And having an A-rated carrier or better is extremely important as you want a premier dollar to deliver claim payouts in the event. So many of the current programs, and even Lloyd's of London, as you mentioned, pulled their coverage from states due to insurability issues and adjusting stances on cannabis risks. So what are some other risks cannabis business owners should be aware of?
Probably some of the biggest risks that they don't necessarily think about. We were talking about crop coverage earlier and the limitations of the coverage that's available. And really, when I said I talk people out of crop coverage, really what it is I try to talk to them about the risks that they're really looking to insure. At the end of the day, we're not necessarily worried about that plant. I mean, outside of my mother plant that's perpetuating my genetics, that plant to me is a consumable good. It's going to be harvested. I'm going to whack it down. I'm going to dry it. I'm going to trim it. It's going to go off to market. That plant's of limited value to me. Basically, it's a value until it's harvested. But really, what it is the business income and the revenue. And business interruption or business income coverage is something that a lot of cannabis businesses don't think about or plan for. And that's really where I see, growers in particular get themselves in trouble. Even if they have crop coverage, let's roll through this scenario I talked about earlier. We've got a plant, we've got a grow room. It's 10 days from being harvested. It's still in a vegetative state. It's not quite to a harvestable state. We have a ballast go out and a light drops a hot light bulb onto my plastic grow table. It now starts a small fire. It burns a few panels in my room. I lose a little bit of air conditioning. I have to shut down the electrical power. I end up losing that entire room to smoke. Now what happens is the insurance company comes in and they say, okay, we're going to settle this out. It wasn't fully mature. Maybe you get a generous adjuster, and I get 75% of the wholesale value, because they say you're 10 days from harvest. We'll call that 75%. We'll do you a solid here. But the problem is that you're handed 75% of the value you were anticipating for that crop today, and your grow room is not ready to go back into production. So what happens is now I've got to wait to get my room cleaned and restored, my lights back up, my grow tables replaced. Maybe I'm out for 2 to 3 weeks, maybe 2 to 3 months. It is not uncommon for it to be 8 to 12 weeks to get that room cleaned and back into production. Now, if you've got a complex grow operation, there could be 8 different grow rooms. How do I now work that grow room back into my sequencing to get my revenue trending the way that my business anticipated it to go? So that one loss of that one crop can mean significantly more consequential damages because you're not able to get back into production. And that's where, that's kind of some of the nuances of understanding where your coverage starts and stops, where business interruption is important, and some of those other components, those fringe coverages that get added in for free for traditional businesses as part of your business package. Everything's a la carte in the cannabis world. They treat us differently.
That gets expensive.
So, Norm, you mentioned the U.S. Farm Bill that recently passed. The 2018 Farm Bill legalized the production of hemp as an agricultural commodity while removing it from the list of controlled substances. So the 2018 bill also listed hemp as a covered commodity under crop insurance and directed the Federal Crop Insurance Court Board to streamline the process for developing hemp policies. So there were 9 states that did not legalize the cultivation of hemp under the previous Farm Bill law. That was Connecticut, Georgia, Iowa, Idaho, Louisiana, Mississippi, Ohio, Texas, and South Dakota. So what are some of the challenges that CBD companies still face, like regulation, crop insurance, supply chain, and THC thresholds?
Well, there still is no crop coverage. There, even though the feds have authorized the government to create the federal crop program, that hasn't been done yet. Basically, what's where they're at in the process at this point is we're waiting on the feds to outline what a program will be, and then each individual state will actually submit its own plan for what it's going to allow hemp cultivation to look like, at which point then the feds will sit down and decide where the crop coverage is available. So I mean, really, the folks that I'm talking to in the agricultural insurance community are talking, we're still early, 2020 before we're going to start seeing crop coverage options really being available for outdoor hemp production. The feds are a good 6 months away from making their rules, and as we talked about earlier, until the feds make their rules, the secondary insurance market, who really provides the coverage the farmers are looking for, are not going to develop their plans until we know what the feds are doing.
So insurance trade groups are praising a legislative effort to ensure that the bank safe harbor is provided for banking and insurance companies working with businesses in the cannabis industry. The amendment will prevent criminal prosecution of insurers engaged in the business of insurance with cannabis-related businesses. It'll also prevent civil liability for agents, brokers, and insurers, their officers, directors, or employees for the same. So it's an important step towards legal certainty for the industry. So in addition to ensuring the needed clarity for providers that wish to offer financial services in states that have legalized cannabis, does this bill provide a good first step to business owners in general?
It does. Actually, it would. The passage of the Safe Harbor Act, especially now that they've pulled insurance protections into it, should have a softening effect on what they're calling a hard insurance market. Cannabis insurance is a surplus lines, hard to place policy. It doesn't go with traditional carriers. And so the further complications of the federal prohibition means that we have fewer carriers. Insurance companies are essentially financial institutions. If a financial institution is worried about transferring money across state lines because they're engaged in a federally illegal activity, they're worried about getting pulled into a RICO claim or things along those lines. And that, frankly, that's why Lloyd's of London pulled out of the market. Ken Bolt in May of 2015 came out with a statement as a an executive in charge of compliance for Lloyd's of London for the U.S., basically came out and said, look, I am not comfortable with our exposure here, and so Lloyd's pulled out of the market purely because they were worried about getting roped into a RICO Act. The remaining carriers that are in the market are now writing, by and large, with one notable exception that I'm aware of, they're writing state-specific policies. That gets very expensive for large operations, especially a large operation who wants to carry an appropriate amount of limits. You think about a MedMen. You've got 140 locations. You are a very attractive target for a lawyer to sue. And yet, if you've got state-specific policies, you're buying 5 million, $8 million, $10 million worth of liability protection within a given state multiple times over, where in a traditional business sense, I would buy one policy and one umbrella policy to lay over the top of all of those. And so now, rather than buying one policy, I'm buying 15 different policies for 15 different state operations. And they each come with fees and taxes, and your costs go up exponentially because of that. So with the passage of the Safe Harbor Act, I believe we're going to get far more carriers involved, and the restrictions that have been limiting the availability of coverage will come off, opening up, should have a dramatic effect on the market, reducing the overall cost and availability of coverage.
So it's going to increase the coverage and reduce costs at the same time.
Correct. I mean, those two go together hand in hand. Right now, you've got a hard market. For instance, one of the hardest things to place right now in the insurance world, or in the cannabis insurance world right now, actually is California delivery risks. Auto in California, they require that you do federal filings or your state filings. Well, the insurance carriers that write commercial auto in California that do the state required filings, they require that you have been insured previously and you have a year of history. You don't have that if you're just now entering licensure in California, moving from the gray market to the regulated market. And so when we've gone to the insurance carriers to say, hey, we need you to come into the market to provide options for cannabis businesses, the pushback that we're getting from the insurance companies is, hey, look, Norm, right now we're losing our shirts on regular auto business in California, and we're raising our rates. I don't need to write cannabis right now. What happens is you add more carriers to the mix, you loosen those regulations, there's more people to fight over that wedge of the pie. But as it is right now, there's so few carriers in that market segment, and the market's still correcting itself, that it's kind of a double-edged sword.
So product liability and product recalls are vital coverage to protect balance sheets, and again will be driven by class action suits and federal regulatory statutes. Having federal approval for cannabis in the U.S. will dramatically lower the risk, but until that time, it's incredibly difficult to provide any actuarial backing to these pricing options as a marketplace is now being created. It takes creativity and structure to place this coverage and trust with an insured underwriter. So how would federal legalization of cannabis impact the cannabis business insurance market?
Well, it would take the handcuffs off. It would remove a lot of the barriers. I mean, when you talk about prohibition, there are a lot of different layers to prohibition. It's federally illegal. No. It's a scheduled substance. You've got baking protections in there. You've got tax complications. So all of those things have an impact on insurance companies. Insurance is time value of money calculations. You take an actuary table, you say, I'm going to lose 3% of every dollar I take in. I'm going to charge 3.5% and figure out how to leverage that extra 0.5% to pay off on my time value of money calculations. So, the removal of those restrictions are just the benefits are going to be exponential. I mean, I really think it's hard for us to comprehend all the different ways that it will have an impact. I mean, as it is right now, I mean, you say that there's no actuary tables. Well, we've seen a federal rollout into the U.S. market. We've seen different kinds of protein shakes and health and wellness items. We're now seeing CBD emerge. It's now out from underneath the Controlled Substances Act following the 2018 Farm Bill. We have metrics and ideas. What we need is the federal government to step out of the way to allow the risk managers and actuaries to step in and do what they do to find applicable data and apply it. The current code that doesn't eliminate the risk of fire damage, but it does reduce it to a predictable margin. But where claims are really, where we're in really what they call a pre-claims environment, has to do with the health implications of cannabis. We haven't seen a lot of health-related claims. So we don't really know where the claims are likely to come from. Trip and fall, we know. You see 10,000 clients in a year, you're probably going to suffer 2 to 3 trip and falls. There are actuary tables that figure out the.
But we don't have any tables for genetics, so my strain is the best, and I have the best Blue Dream on the planet. So how are you going to pay out for my cultivar when there's no other? I mean, you need a comparative market analysis, and yet we don't have any of that, so it needs to be established.
Correct.
Who goes about establishing the price paid out for genetics?
And that's where that's truly a negotiation, or should be a negotiation or a conversation that you have with your insurance broker, trying to figure out how to evaluate it and how these policies are going to settle out. Because, for instance, the policies on genetics, on crop coverage, you're settling out at the wholesale value of the plant. And so just because you're getting a 3x markup at retail, that's not what the insurance carrier is going to pay out. They're going to pay based on the value, the wholesale value it was to you. And frankly, that is the biggest challenge where I found in my insurance practice, I talked people out of crop coverage quite often because it was very expensive for what it was covering. And when we started looking at the settlement, the crop coverage was not going to be a great deal for them, in that if your plant is at a vegetative state, it's not quite flowering yet, you've got it in your dark room, you're trying to veg it out a little bit right before it pops, you suffer a loss at that point. They're giving you 50% of the ultimate wholesale value of that plant.
So you need really expensive genetics. If you have expensive genetics like the Stanley brothers that have a strain specific for epilepsy, that might be worth it if they lose their entire genetics to blight or some kind of something that would destroy all of their IP.
See,
Are we going to see that in the future where there's $1 billion payout because they lost all of their genetics to fire or theft or otherwise?
Right now, you don't have carriers willing to put up limits that high. I mean, when you start talking crop coverage, a lot of times your primary insurance carrier is only willing to cover $1 million, $1.5 million maximum value of crop. And so beyond that, now you're looking at maybe bringing in a second and a third insurance carrier, and that second and third layer of coverage may not be as robust as that primary carrier. They're saying, look, I'll cover you for another $1 million in excess of the $1.5 million, but I'm only going to cover fire and building collapse. I'm not covering mold, rot, human error, disease. By and large, the crop coverage that are available for cannabis operations are not what a farmer would call crop coverage. This is building coverage for plants. It's 7 named perils. You're talking wind, hail, airplane, falling object, fire, smoke, explosion. Smoke from a hostile fire. Those are your 7 covered perils. So you think about what's not covered there. Pests, disease. If something happens where a watering meter goes out inside my building, not covered. There was not a qualifying loss to the building first. If the building didn't catch fire first, causing the loss, there is no coverage.
And that's going to be a big deal moving forward with outdoor crops that have a particular year-over-year varietal difference within the same chemovar or strain. So 2015 Blue Dream might be better than a 2018, and yet if that crop were to be decimated, we're going to have to figure out year over year how that same crop could differ in pricing.
Correct. Yes.
That's interesting stuff.
Yeah. No, it's really on the cannabis side, the regulated marijuana side, if you will, of the cannabis strain. Their crop coverage very hard to come by. Essentially not available for outdoor crops, very, very low limits, almost no coverage available for outdoor. You're really looking at primarily building coverage for plants, for indoor and greenhouse grows. But with the passage of the 2018 Farm Bill, you'll start seeing hemp hemp-derived CBD, cannabis with less than 0.3% THC, now will start falling under the crop program, the federal crop program. And the feds will now come in and establish what the national crop insurance program will look like and what perils will be covered. So they might go into like Kansas and say Kansas is particularly heavy in hemp. It's a good environment for growing hemp. We're going to provide crop coverage that'll cover pests and weather-related issues, but we're going to exclude wind and named storms. Yes, there we go. Because we know that Kansas is in Tornado Alley, and the feds don't want to cover the tornado. So at that point, the private market will step in. But really what we need is the feds to establish what's going to be covered first. And then the private equity insurance market will step in and establish that secondary market from there.
Regulatory-driven claims are the main driver of directors' and officers' liability insurance coverage, which is becoming more prevalent with companies becoming public and raising large amounts of funds in the private equity space. So regulatory coverage is imperative, as all suits will be based upon federal statutes and will most likely be class action based upon product liability and potential product recall situations. So what are some of the challenges of insuring a cannabis business while cannabis remains illegal under federal law?
Well, that's the challenge is it's illegal under federal law. So the hardest placements to come by right now, the hardest insurance policies to write are directors and officers and errors and omissions coverage, because those tend to be financially based, and we've got financial restrictions in place because we're still a Schedule I substance. So by and large, there's no publicly traded cannabis companies in the U.S., so you don't have directors and officers options for publicly traded cannabis companies. And the few options that are available for privately held cannabis companies, which should be all we have, are fairly expensive and limited. Once Jeff Sessions pulled the Cole Memorandum, it gave a number of the carriers in that financial services sector great pause to feel that they had lost some of their cross-border protection. They just weren't sure how to interpret that. And so they were already a little bit uncomfortable in the market. So he pulled that back, and those carriers then pulled out of the market. And so what we saw was policies, literally a policy that I had quoted for one insured that was $4,500, $5,000 for the year for his directors and officers for a small operation, and it includes some employment practice coverage for him. That same $4,000 policy, after Sessions pulled the Cole memo, 90 days later, that same policy was $24,000 and had a $20,000 deductible, and the coverage had eroded significantly so that the protections included were probably about a third of what it had been before.
Wow.
So 5x on price, 1/3 on coverage, and your deductible has now gone to $20,000. Here you go. Would you like to sign this today?
So how would you advise people to take on advisory roles? Because as a board member, that's who gets sued. When you sue a company for like, let's say you're a vape company and you have Eagle 20, a herbicide, and it causes cancer, and someone sues you, you're suing the board of directors, and if that board of directors doesn't have proper coverage, that's going to be a disaster.
Yeah. Well, take it one step further. Now, I've had attorneys argue both sides of this with me. I need to say I'm not a lawyer. I don't play one on TV. I'm not giving legal advice. But think about this. When it comes to cannabis, it is a Schedule I substance. You do not get traditional tax treatment. You are excluded from filing debt like every other, filing bankruptcy, excuse me. You get no federal bankruptcy protection for cannabis-related debt. So you sue my operation, I'm underinsured. Now I've got a claim out there, a class action claim that's trying to collect $3 million in excess of what my policy covered. Where's that going to come from? Is that the personal liability now of my directors, officers, and investors?
So worst case scenario is you have a pre-money valuation company and they don't have any board of director insurance. And then that company claims that their pre-money valuation is $1 million because they have the neatest logo. And so then they end up making some sales and they go to Canada. They have a reverse takeover.
file public, and then all of a sudden, initial shareholders realize that that pre-money valuation was fictitious, and end up filing a lawsuit, which I think we're going to see, even in Canada. I think we're going to see shareholder lawsuits based on improper valuations. And so that's a compounded issue. I don't know, man. Do you have a crystal ball? Like, what's going to happen with that?
Yeah, no, I don't have a crystal ball. I mean, really, so much of this hinges on if we get the Safe Harbor Act through, that clears a lot of these restrictions that are holding us up on the financial side. You now make it a little more viable for these financial companies to step in and provide financial protections, because it's no longer federally banned. It's no longer subject to unfair tax treatment and prosecution.
So you're saying the whole world revolves around money?
Yes.
And with that, we're going to wrap this up. I'm Josh Kincaid. Thank you, Norm, with Worldwide Facilities. Don't forget to like, share, and subscribe, or don't. And from Jimi Hendrix Park on 420, I'm out.